Hello, and welcome to the Invest with Carl podcast. This podcast will bring you obviously everything about Carl investments, discussions about new features and strategies being launched, as well as commentary on general alternative investments news, slanting towards quantitative perspectives and the general democratization of sophisticated investments. Or said simply, bringing high-quality, sophisticated investments to all investors. We're looking forward to the conversation, so let's get started. Hi, I'm your host today, Jamie Uppenberg, and a member of the Carl team. We're chatting with Dr. Ernest Chan from QTS Capital Management, Quantitative Strategies. We'll ask the usual first questions about this fund, like what makes it so successful, a little bit of fund history, and what's important for investors in this fund to know. We are Carl, digitally offering quantitative hedge fund strategies as funds of funds, packaged and data-driven delivery to accredited investors. QTS Tail Reaper is an offering from Carl as Olympus. Dr. Chan is pretty much a quantitative rock star. He's written 3 books on quantitative, algorithmic, machine learning, and trading to considerable acclaim. He writes the popular quantitative trading blog. He's worked for IBM, Morgan Stanley, Credit Suisse, Maple Ridge Capital Management, and he founded EXP Capital Management before finally founding QTS Capital, where Olympus is from. Hi, Ernie. It's great to be chatting with you today. How are you?
I'm great. Thanks for inviting me, Jamie. Good to be here.
Good. So we always start off with what has made your tail reaper strategy successful so far? And we ask that is, if you weren't managing it, why would you still have it in your portfolio?
Well, tail reaper is a tail hedge strategy, as the name implied. It makes money only when everything else is crashing down. You know, the economy is going south, or there is a huge financial crisis, or when there's a pandemic, for example. And it has proven to work in multiple crises in the past. We had traded live since 2012. And during that time, we experienced the 2015 last quarter Chinese stock market crash, which affected the US market, even though it only traded the US S&P 500 index future. But that generated great return during that quarter. It also generated good return in 2018 when we had the so-called taper tantrum, or the Farmageddon, where people are afraid that the Fed is going to increase interest rate. And then, of course, it had the stellar performance in 2020 during the pandemic, especially the onset of the pandemic. So I would have this, and in fact, I am having it in my own portfolio as part of our portfolio mix, because many of us, I would say most of us, have long exposure to the market. That is, most of us hold stocks, mutual funds, ETFs, whatever. We are most of us will be vulnerable to this kind of stock market crash, financial crisis, and so forth. And it would be great to hedge against that kind of sudden risk. We are not talking about, the market is down 1% a day. I don't like that. No, we are talking about markets down 20%, 30%. That's the kind of risk that we don't want to ever suffer. And tail reaper is one that will hedge against that. And so definitely I am having it in my own personal portfolio through my hedge fund. Whether I'm the one running it, if for some reason we stop running tail reaper, we will look for an alternative somewhere else, from some other manager. But this is the kind of strategy that is a very low cost way to hedge against this kind of financial crisis.
Right, because you guys, it's important to you to be able to protect the capital while the market is doing well, right? While it's not crashing. And then obviously Olympus really the tail reaper really performs and has performed in the past when it was crashing, when the other markets are crashing. So obviously as tail reaper management, and now since I I think it was October, Olympus started. You really care about hedging the tail risk suffered by the long beta portfolios. And just for our listeners, beta returns are attributed to the overall market returns, or you could think of it as volatility, whereas alpha returns are independent of the overall market and they're performing separate from the volatility. So the risks from that long beta portfolios, was that always how you imagined Tail Reaper? Was that what you wanted to do from the beginning, or has it changed over time?
Yes, it has always been the intention. Before we traded Tail Ripper in our own hedge fund in 2012, we were running a fairly high frequency spot forex strategy, foreign exchange trading strategy. That strategy had a period where it practically make money every day, but it is very vulnerable to black swan events. So, and one came about in August of 2011 when the US Treasury debt was downgraded the first time ever in history. So that caused a week of turmoil in the market. It was just completely berserk. And our previously highly successful Forex strategy suffered a 35% drawdown in the ensuing chaos. So that was quite a shock. And so in order to protect this strategy from this kind of tail risk, we look for a tail hedge strategy, and we found one in the following year, and that is the earliest form of Tail Ripper. Of course, over the years, we continue to improve on Tail Ripper, adding different inputs, applying machine learning, risk management, and so forth. But the reason, the rationale for creating it was to hedge the risk of other strategies, such as long-only strategies, such as strategy that will be severely hurt when the market is in turmoil.
Right. And you guys have you have some research about, it's not just like, a lot of people would say, well, the market's going to go down, but it's going to come back up. So it's just about, making it through. But you have some research that actually, if you have a strategy like this in your portfolio, it doesn't just help you psychologically, right, while the market's down. It actually will lift your total portfolio. Is that right?
That's right. So the objective of most investors is to earn the maximum compound rate of return. It's like having a bank account that pays you 10% a year yield rather than, the current 0%. So compound return is what we care, because it is not so much, the average return. We don't normally take the profit or the interest out of our bank account. We reinvest it. So when we compute compound return, risk becomes very important, because it is not just a matter of, if you have two instruments where one is going up steadily every day, go up maybe 0.1%. And then the other one sometimes will go up 0.2%, sometimes will be negative 0.1%, and so forth. Although both of them might average the same, may have an average of 0.1% every day. It so turns out mathematically that the strategy that has lower volatility will generate a greater compound rate of return. It is a complicated way of saying that if a portfolio go up 10% one day, and then I'm sorry, let's say the portfolio go down 10% one day, and then go up 10% the following day, well, we are still have a negative P&L. Just because both days, it seems like they're symmetric. One day is up 10%, one day is down 10%. But if it's down 10% first and then go up 10% afterwards, the compound return is still negative.
Right.
So that's the simple reason why we desire a portfolio that has as little volatility as possible.
Right, right.
And that's why Tail Ripper is used to hedge out those extreme volatility, when the market was down 20%. And we want to smooth out that kind of abyss in the equity curve.
Right, because your goal is, keep it steady while the market's bull, keep it moderate, and then it really performs when there's a downturn, right? That's the
Correct.
crux of the fund. And then I should say the intended goals of the fund, which it has been able to do in the past. So as obviously there's a focus on your fund. You're the first tail reaper in the Carl investments as Olympus, and there has been interest. And so this is a shift for QTS and for Tail Reaper to come along in what we call the investments digital revolution. And so we always ask the question, now that, you're having retail investors in the fund, how does that change how you think about quantitative hedge funds, or specifically Olympus, moving forward?
Well, I think that the most important thing for a retail investor to understand is that financial products should not be looked at individually. One has to take a portfolio point of view. So, for example, many times people would recommend you to have a mixture of bonds and stocks in a personal portfolio, because sometimes when stock goes down, bonds will go up, right? So it's the same with investing in strategies. Different strategies do well in different times, and for a tail hedge strategy that like Tail Ripper, it only makes money maybe once a year, maybe once every 2 years. It only makes money when you really need it to make money. Other times it might be flat or even have a drawdown. So it is great to see a product like Carl, which offer multiple strategies, because then the investor can choose to invest in a multiple of them without having a huge investment. It's like a supermarket where you can buy multiple products at the same time. So that's, I think, is a great revolution, a great benefit to the retail investors. Whereas previously, if you want to invest in a hedge fund strategy, the minimum is oftentimes $1 million. That's a typical minimum for hedge fund investment. Now it's much lower, and yet you can benefit from the investment in multiple strategies to diversify the risk of a portfolio. It is never a good idea to only chase the performance of a strategy that did well in the last 3 months. So it's always good to put the money, spread it around, and benefit from the diversification, benefit from the inherent hedge that provided by one strategy against the other. So that I think is the power of Carl.
Yeah, and definitely the power of Olympus in a portfolio, I think, as well. Just I haven't seen this kind of opportunity to diversify where you can really protect against the harsh downturns, right? And if someone's even dependent on their investments for income, right, this is a quality protection. It looks like at least the intention of the fund is there for you in a considerable time of need. So obviously the fund performed well at the beginning of the pandemic, and then markets have been very interesting since. It's been an interesting year, 2020, but we're in 2021 now. So as our investors watch Tail Reaper, and then Chimera is also one of your funds, what would you say is something investors could feel really good about? Or said another way, what does Olympus work really hard at?
Well, the one area where we work hard is to manage the drawdown of the strategy when everything in the market is going well. That's interesting. It's ironic because when the market is doing well, we usually don't do well. And so one of the key research area that we focus on is how to make sure that it at least is flat. We don't expect it to make money when everyone else is making money, because this is a hedging strategy. It's designed to be added to a long-only portfolio as a hedge, right?
Right.
So But nevertheless, as a hedge, we want to minimize the hedging cost, is another way to put it. We don't want it to lose too much money. We don't want it to eat into too much of the bull market profits of the investor. So that's where we spend our most time on. And we have made a lot of progress since 2019, where we implemented a machine learning based risk management system, which would veto our trade or would decrease the allocation on this strategy when the machine learning system decided that the market does not require tail hedging. And it had worked very well in practice. So for example, people looking at our track record will notice that there are 3 months starting in November 2019 to January 2020 that we had not traded a single time. And people thought, hey, are you guys asleep on the wheel?
Yeah.
And we said, no, that's because our machine learning risk management system said 3 months are the calmest time in the equity market. Economic growth was high. The trade war issues have been resolved, at least temporarily. There's no risk of increasing interest rate by the Fed, and political environment is stable. So everything was going well. There's no tail risk in the horizon. Why bother to waste your money to trade a tail hedge strategy?
Exactly.
So we didn't trade, flat. And then suddenly on February 1st of 2020, our machine learning system, which monitor at this point 170 variables around the world, decided that there is rumbling of a tail event coming. It was amazing. It was amazingly present because at that time, even the federal government did not issue any warning that there's going to be a pandemic raging in the US. Yeah. But our system already detected through market variables around the world that a high probability of a sharp downturn is coming, and it asked us to start tail hedging, which led to I'm not permitted to disclose a number in public, but it's a very high return in the next 3 months. Yeah. And conversely, and it's also interesting to look at the opposite. In November, we had a Pfizer vaccine announcement. That event caused a humongous market reversal, actually. On that day, people say it's a 20 sigma event. All the momentum stocks that were going so well sharply underperformed value stock. The market, I think before the market opened, it was up maybe over 5%. And then the end of the day was up barely, 1 to 2%. The market reverted 3 or 4% during the few hours. And our risk management system ahead of time, a few days ahead of time, told us to shut down the tail hedge system because they again detected that some major announcements comes. I don't know how they know it, but it detected that some market participant is expecting a tail event, and it shut down our tail. Not a tail event. It expected a sharp reversal, which won't be the reversal, tail ripper, and it asked us to stop trading. And if we had traded that day, that would be a big loss, but we didn't. It was flat. So risk management is actually our main focus because the underlying strategy worked well every time there's a tail move. You don't need to improve it too much. But risk management is our main focus to reduce the hedging cost.
Right. And I mean, so far, it looks like you're improving on the risk management side, which makes the purpose of the fund, the intention of the fund working relatively well, at least in 2020. That it's great. It's a very interesting fund. It is an interesting new opportunity for people, even like me, who I've never traded in funds like this before. And I am in Olympus. So we will talk more about the risk management. It's on a lot of investors' minds wading into this because this is their first time in quantitative hedge funds. But well, for today, we thank you so much for chatting. It's been so educational. And what's your final word for our investors today?
Well, diversification and a long-term horizon is my final word.
Tried and true. Ernie, thank you so much for joining us. Investors, thank you for joining us for another episode of Invest with Carl, and we will see you next time. Bye-bye now.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.